Hey, this is Mike, and I just made some new buys today in gold and silver stocks. I believe that we saw them crash last month, and they're stabilizing, and I think they're halfway through that process, and I think today we're seeing a successful retest. I'm going to get into them real quickly in a second, go into more detail, but first I want to show you something someone just sent me, because I think it's absolutely incredible. This is a poll done by Bloomberg of 906 of their Bloomberg terminal customers. And these are their views on the economy and the financial markets. They're asked, what do you think is the biggest risk to the global economy in 2013? Number one, Europe debt crisis, 36%. Slowing Chinese economy, 30%. Size of U.S. debt, 16%. Terrorism, 1%. None of these, 7%. I'm looking at this from a contrarian standpoint. I find it fascinating that most money managers using Bloomberg terminals are still terrified of the European debt crisis. At least 36% of them. That's the thing in the whole world they're the most scared of. Personally, right now, I'm most scared of the debt that the U.S. government has in the Treasury market and this quantitative easing that I think is going to blow up in a couple years, but no one else. No other money managers, they don't care. They're not worried. Their general view of the markets. Among the following markets, which one presents the best opportunity to buy now? The United States, 53%, despite the fact that the United States stock market's gone up now for like 4 years in a row, is one of the most expensively overvalued stock markets in the entire world. Japan, they like next, and Japan's gone up the most this year. The European Union, 18%. United Kingdom, 5%. Russia, 9%, and Russia is actually one of the cheapest stock markets in the entire world. Which stock market do they believe provides the worst? In other words, which one would they avoid? The European markets, 45%. And since essentially a year from July of last year to now, the European stock market's been one of the best performing markets in the world. But they say, no, stay out of there. And they think the United States is the safest. Yes, the United States stock market's gone up for the past couple months in a great rally. But I'm just telling you, from a contrarian standpoint, all the professional money managers are all excited about the United States, and they hate Europe. And I think if you're interested in investing in Europe, or you are invested in Europe like I am, that's a good sign from a contrarian standpoint. Now take a look at this. Which asset class do you think offers the highest return over the next year? Number one, stocks. The money managers are the most excited about stocks. What do they hate? Bonds and gold. They hate gold. Think about that. Which asset class do you think will have the worst return? Bonds and gold. They hate gold. It's fascinating. They hate gold, even though I believe, actually, I've got the opposite view. I think gold and commodities are going to do the best over the next couple years because we've seen gold crash, silver crash, and I think we're seeing a stabilization process right now, and a new bull market should start in 4 to 8 weeks from now, which if it happens, that'll make that the best place to invest in the whole world. But hey, the Bloomberg people, the people that use Bloomberg terminals, the money managers, the hedge fund managers, the dudes on CNBC, they say I'm wrong. Well, I'm betting against them because I bet on what I believe in and not what everyone says. I don't bet on what CNBC tells me. I bet on what I see the charts do. I bet on undervalued stocks, undervalued sectors, undervalued countries. I look at valuations. I make positions. I truly invest. I don't just chase momentum. No. But most people do, and that's why we're seeing these, poll numbers, and I think it's absolutely incredible. And they love the way the Federal Reserve is handling the problems facing the economy. The U.S. Federal Reserve, 57% of Bloomberg terminal users think the Fed's doing a great job. They're only saying that because the stock market's going up. If they would talk to some of my friends that have lost their jobs, they're unemployed, and if they ask them what they think of the Fed, they'd get a much different answer. But no, they're asking Wall Street terminal users, Wall Street Bloomberg terminal users, what they think of the Fed. I mean, good grief. So anyway, I just wanted to. Oh, this is neat too. This is what they plan on doing. 54% of these dudes are going to increase their exposure in the U.S. stock market. And if you ask them about commodities, what are they going to do? Most of them say they're going to reduce their exposure. 42% of Bloomberg terminal users want to reduce their exposure in gold, and 34% want to reduce their exposure in commodities. 15% say they have no idea what they're going to do. 55% of them believe that the S&P 500 will be higher 6 months from now from where it is now. 50% of them believe gold is going to be lower. I would assert, if you want to do the simple bet right now and go against what you're seeing on television, go and say, oh, I can't go against the Bloomberg terminal user. I can't do that because they wear suits and they're on television and they're running hedge funds. Well, look, most hedge funds have lagged the market over the past couple of years, and most of them end up going out of business within 5 years. So if you want to do something, do the opposite and get out of this S&P 500 and get into gold. I'm not saying the S&P is going to crash. I don't think the S&P is really going to be lower than it is 6 months from now. But I think gold's going to outperform. And today, I'm not just saying these things to you. I'm not some like stockbroker that's trying to peddle you a mutual fund so I can make a commission. I put my money where my mouth is, and today I bought gold and silver stocks. Let me show you why first. Remember, if you've been following me for the past couple months, I wrote this article I'm going to show you exactly a month ago, 4/16/2013. I wrote it a few days after gold and silver crashed, and gold stocks crashed too. In fact, in one day, GSS was down 25%. And this is the article I wrote, and I laid out exactly what I was going to do, and now I'm doing it. Okay, this is the chart I showed back then. I said, look, gold crashed in just like 2 days. It was down. And I said, well, what happens? Most people are panicking. CNBC was going crazy, telling people that it's over and get out, and it's a bear market now. And a lot of people had to liquidate, if they're on margin, and if they're managing people's money. Now they were ashamed to be owning these things. They don't want their customers to know it, so they sold. And now they're rationalizing that decision to sell when they're getting told they're being bearish. And you know how sentiment works. Well, I was saying let's step back and let's study crashes and what happens after a market crashes. And we can learn from that. And I did that. And I looked back and I thought, well, they all got a similar pattern to them. Most of the time after something crashes, it doesn't simply bottom out and go straight up, but it stabilizes and enters a sideways trend for about 8 weeks. It consolidates for 8 weeks. The way my writings talk and stuff, the way I would interpret it is I would say that a crash like this is a very, very short-term bear market. A drop that we saw last month can occur over a pace of a year. But a crash is condensing price action in time, and that stabilization phase that comes after crash is a condensed stage 1 base. After a bear market, a lot of times you'll see a stage 1 base go on for 6 months or 12 months. We saw that in shipping stocks, in coal companies, and all sorts of sectors, okay? But after a crash, since time's condensed, that consolidation phase essentially can play out in about 8 weeks. If you study crashes, that's about the typical time frame. And if we look at the 1987 stock market crash as one example, after the crash occurred, and this is the typical pattern, after crashes and during the stabilization, you get a rally back up fast over 2 or 3 weeks, and then a retest of the low. Sometimes it makes new lows, sometimes it holds up, but it doesn't really, if it breaks down to a new low, it doesn't really fall that much, maybe 10% at the most. After the retest, we bounce back up and then pause for about another week and then break out. And after that breakout, a new bull market starts and essentially just goes a lot of times straight up week after week from then. And I think that's what's going to happen with these gold and silver markets. So what we're seeing now with gold stocks, and I drew a projection for how this could play out if it follows the pattern of these crashes and completes it. It's already done it halfway. After the crash, we bounced back up close to the 300 level on the HUI, and now we've broken back below it the past week, and today we're bouncing back up. And if the pattern holds of the stabilization process, we'll see the HUI rally back up to about the 300 level, 290, 280 to 300 by the end of May, and then pause in June, and sometime between the middle of June and middle of July, break out of what will be new resistance, probably 290, 300 on the HUI. And if we clear that resistance, bam, it'll be in a new bull market, and it'll be off to the races. And all these money managers who are now bearish on gold and say they're reducing their gold exposure will be left behind, and they'll be in a panic to buy as the prices go up. So, based on what I think is happening, and it seems to be playing out so far, I decided to buy some gold and silver stocks today. I should go through them with you in a second. But my plan is I took a position here, about 10% of my count, less than 10% is what I invested today. And I'm now 90% invested. And if the pattern plays out, I'm going to add on to this position sometime in June or July, and ride it on out. So I'm averaging into the market. I had a small 5% or so position left from the crash. I've now added another 10%, so I'm about 15% invested. And if the pattern plays out as I'm projecting here, I'll add on. Now, if we go up and then break down, I may reduce some of my exposure, or if it doesn't play out like I think. But this is the historical pattern, roughly, that is typical of most crashes after they occur. And I'm playing that. And I'm going against what all the current sentiment is of being very negative on gold. And let's talk about trading and investing, because most people, frankly, are looking 1 year out and they just chase the momentum in the market. They chase the chart patterns. When the market goes up, they jump in and they chase what's on television. So, yeah, the S&P 500's gone up so far this year, so they buy, and they're afraid to miss out because it's gone up. And gold's gone down, so they don't want to mess with that. And Europe has gone up over the past year, but it hasn't gone up the past few months as fast as the U.S. stock market, so they're scared now. The truth is, though, if you truly want to invest, you have to do more than just chase things. You have to do more than just look 6 months out or 1 year out. You have to look for bear markets to play out. You have to look for things to get cheap. You have to take advantage of crashes and then in bear markets. We saw that in a bear market last year in Europe. We saw a crash in gold and silver. Those brought potential investment opportunities. Now you have to combine that with something else that people don't do, and that's to truly, and I emphasize the word truly, invest based on fundamentals and valuations. And I emphasize the word invest. And how do you do that? You based on cheap valuations. You just don't buy because something has growing earnings or because it has a good story, which is what most people do. It's what the professional money managers do. They just talk about earnings growth and they rationalize chasing momentum with stories, and they don't look at the actual price that they're paying. They don't look at book value. They don't look at dividend yield. They may look at the earnings growth for this year and get excited, but they don't look at the price that they're paying for the earnings growth. They don't look at the forward PEs. They don't look at the PEG ratios. They don't look at all these other metrics. They simply buy, and then they tell you a story about how earnings are gonna good, how companies are beating estimates. I don't give a damn if a company beats estimates. I want to know what price I'm paying for earnings. So that's why I'm also buying these gold mining stocks today. And let's talk about the ones I bought, and I'll show you. I bought Newmont, okay? Newmont is paying a 4.2% dividend. It has a PE ratio of 9, and because of its earnings growth the next couple years, it's trading at a forward PE of 9 also. So it's trading at a cheap valuation in regards to future earnings growth, and it's paying me a 4% dividend. Get out of here, but it's doing it. Let's talk about KGC, Kinross. Kinross is paying a 2.9% dividend. It's trading at a forward P of 8. It's trading at a book value of 0.61. What does that mean? That means if someone broke up the company and just bought it, not even caring about earnings growth, just bought the thing, bought the mines, bought the equipment, bought the operations, it's trading at a vast discount to the buyout price. The book value for Kinross is $8.71, and it's trading at $5.44. In other words, it's trading at a cheap valuation, and it's trading at a discount. Let's talk about PAAS. Okay? That's a silver stock I bought. It's one of the biggest silver mining companies in the world, but despite that fact, it's trading with a 3.9% dividend and a forward PE of 10.43. Okay, let's talk about HL, and I can't believe the price I paid for this. I paid $3.21 for it, and it doesn't pay a dividend, but it's trading at a book value also of I've got to look this. I got to verify this because what I'm looking at sounds so crazy here. I've got to make sure I've got this number right because it doesn't sound like it can be correct. Book value 0.77. The book value per share is $4, and it's trading at $3.21. So it's trading at a big discount from the book value. In Pan American Silver, it's got a book value per share of $17.91. So it's trading also at the 0.67 discount, which seems to be the discount most of these mining stocks, a lot of them are trading at right now. And I also bought GDXJ, which is an ETF. I already owned it, but I doubled down on my position today. It's paying a 4.5% dividend with a P of 9. Okay, and man, it's just it's neat to see the action in gold stocks and silver stocks. I really feel good about it. It's one thing to make projections like I was doing a month ago on how this could play out, and I was excited about it because what excites me in the markets is to see something fall and make a great entry point by getting to a cheap price and a cheap valuation, because I know that's how you make real money investing. And once you get in like that and stuff goes up 6 months later, you don't really worry anymore about what's going to happen. I mean, I got these European positions that I bought a year ago, and some of them I'm up. Like I bought into GREK, the Greek stock market, the GREK ETF. I'm up almost 70% in that. So I don't care if it pulls back on a little correction. It can fall 10, 20%, which happens in bull markets, and I wouldn't care. And that gives me the ability now to hold it and realize the gains over the next couple of years I think is going to come, and not worry, not stress, not even think about anything. And by not thinking about stuff or not having to stress out, I can kind of trade and make my investment decisions at a leisurely pace. I can just look at things, a little bit every day, spend a couple hours a week, and that frees up time for me to work on other projects that I like to do, write books and do stuff outside and communicate, make videos and write to you, and without any worries. I'm not like Jim Cramer on TV all stressed out about trading because I'm investing. and I'm getting in when things are cheap and when things are good and when I can get dividends. But to do it, one thing it requires though is to free yourself from trying to just follow what everyone else is talking about. And everyone's talking about the S&P 500, and you got to free yourself from the Wall Street mentality of the Wall Street herd and the idiots that are just, answering these polls on Bloomberg, wearing their suits, getting paid commissions to manage people's money, and be afraid to make a mistake and be afraid to own something that others aren't owning. The worst thing a money manager could do right now is buy gold, right, after it's crashed and after the TV says no, 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 and have it fall even more. Someone who does that, their customers would take their money away. Someone who was to invest in Greece or to put their money in Cyprus when it's told to be a dangerous place on the television and have that investment fall 50%, they could even be sued by an investor. And if they just buy the S&P 500 or Apple or Dell or Cisco or Intel, and those stocks fall 30% or even 50%, no one would sue them because they would just say, oh, I'm just doing what everyone else is doing. 90% of the other people are doing this, so it's not my fault. In fact, what they'll say is it's the fault of some other event they didn't know about. Well, I'm going to tell you what that event is that they don't know about that's going to happen one day. It's actually going to send gold prices higher, and that's going to be trouble in the U.S. bond market. Not today, not next week, probably not even next year, but one day it's going to happen. And when it happens, these guys are going to get killed, and I think it's like 3 to 5 years away from now. And that's one reason I believe gold's going to go up. Gold's going to go up as the bond market goes down because gold's going to act as a safe haven. And these money managers are going to lose their money in the stock market, and they're going to tell their clients, I didn't know the bond market was a bubble. Well, how can they say that? Craziness. So there's high risks in this market as a whole, but there's pockets of low valuations and safe havens that I don't believe are risky. And in fact, I believe they'll benefit from the risks that are out there. And that's what I'm interested in. That's what I'm investing in. And that's what I'm going to keep talking to you about with. And we're going to enjoy these markets and have fun in them. And we're going to see, this pattern so far that I was looking for a month ago has played out. It appears to be playing out today, and that's why I bought today. And let's see what happens over the next month. Because if it continues to play out, man, we're going to be looking at, practically a sure bet to add on or buy new positions in June or July. And so if you want to feel safer about buying stuff, just wait to then. Wait to see if this pattern plays out, and we'll do this together. So, be talking to you later.